The global recession of 2008, also known as the Great Recession, was one of the most severe economic downturns in modern history. It was caused by a combination of factors, including the collapse of the U.S. housing market, the bursting of the housing bubble, the subprime mortgage crisis, and the failure of large financial institutions. In the years leading up to the recession, the U.S. housing market experienced a massive boom. Low interest rates and lax lending standards allowed many Americans to buy homes they could not afford. This led to a housing bubble, with home prices skyrocketing and many people taking out subprime mortgages, loans given to borrowers with poor credit histories and little or no down payment. However, by 2006, the housing market had peaked, and home prices began to decline. This led to a wave of foreclosures and defaults on subprime mortgages. Many financial institutions, including banks and investment firms, had invested heavily in these mortgages, and when they began to fail, the financial system began to unravel. In 2008, the crisis hit its peak. Lehman Brothers, one of the largest investment banks in the U.S., declared bankruptcy. Other major financial institutions, such as Merrill Lynch and AIG, were on the brink of collapse. The crisis quickly spread to other parts of the world, as banks and investors around the globe were exposed to the risks of the U.S. housing market. Stock markets plummeted, and credit markets froze up, making it difficult for businesses and individuals to obtain loans. Governments around the world responded with massive bailouts of the financial sector, in an attempt to prevent a complete collapse of the global economy. Central banks also lowered interest rates to try to stimulate economic growth. The impact of the recession was severe and widespread. Millions of people lost their jobs, and unemployment rates soared in many countries. Businesses struggled to stay afloat, and many went bankrupt. Governments around the world also faced a significant challenge, as they struggled to manage the crisis while also dealing with rising debt levels. The recession also had a significant impact on the global economy. Economic growth slowed or contracted in many countries, and the world experienced the first synchronized recession since the 1970s. It took several years for the global economy to recover fully, with some countries experiencing a prolonged period of slow growth. The global recession of 2008 led to significant changes in the financial system and regulatory environment. Many countries implemented new rules to increase transparency and reduce risk in the banking sector. Governments also took steps to improve oversight of financial institutions and reduce the likelihood of future crises. One lesson learned from the crisis was the importance of a stable and resilient financial system. Countries around the world have focused on strengthening their banking systems, improving risk management practices, and increasing capital requirements for financial institutions. Another lesson learned was the need for coordinated global action in times of crisis. Governments and central banks around the world worked together to try to stabilize the global economy during the recession, and this cooperation was seen as a critical factor in preventing a complete collapse of the financial system. The global recession of 2008 was a significant event in modern economic history, with far-reaching impacts on individuals, businesses, and governments around the world. While the recovery has been slow and uneven in some areas, the lessons learned from the crisis have led to important changes in the financial system and regulatory environment.